All right, guys, so in this video, you're going to meet 47-year real estate development and private equity expert Randy Wallace right here in Myrtle Beach, South Carolina. Now, he is the broker in charge of Keller Williams right here in our city. Now, he's worked on as many as 40 real estate development deals. You're going to hear life lessons, you're going to hear blunders, you're going to hear successes and words of the wise right in this video. Let's get into it now. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because you can enjoy and increase the passive income of your oceanfront condo through the 20 to 22 million tourists that visit the #2 vacation destination on the East Coast each year. Not only can you enjoy the equity paid for by visiting tourists, but you can also anticipate the over 100% appreciation experience at many of the oceanfront resorts in our market during the recent decade. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because you can depreciate them, reducing your overall tax burden, keeping more money for you and your loved ones, and ensuring unnecessary taxes aren't paid. All right, Randy, can you walk us through your first development project and what you learned from that experience?
Well, the first development project I did was working for somebody else, and there were actually several of them. And what I learned in doing that those projects, it just took a lot of consistency. You had to stay on top of everything every single day. Details were important. That you had to, working with the architect, working with the engineer, working with buyers and buyers of the project we were developing. But there were always a lot of details, and you had to be consistent and show up every day. You couldn't skip. You had to stay on it. The rewards were great at the end, but you had to stay focused. That was the number one word I would use, to stay focused on the project, doing that one project from start to finish.
Wow. Okay, so now when you say focus, can you speak to a little bit of the things that would have distracted you and stopped you from being able to get through to the end?
Well,
things that maybe you said no to?
Yeah, everybody wants to chase rabbits. Everybody wants to, there's a shiny little thing over there, I want to go chase that. Oh, I got this great idea for this other project over here. But you have to, the project is not just an idea. It's got a lot of details to it. So you have to stay focused on that. The success is in the focus. If there's not somebody focused on and responsible for that project from start to finish, it will not go well. You can't be doing that and then, be second or third or first on 20 other things, and be able to finish a project successfully. Somebody's got to be in charge and get it done.
So when you do projects, you're doing one at a time?
Not necessarily doing one at a time, but if I have somebody, I have to have a partner or a manager or somebody else who can be responsible for the things on that project. Again, you can do multiple projects, but if you're doing multiple projects, you have to have a partner or a manager who is the go-to person for each project when you're not available.
Exactly. So there's always somebody carrying the ball.
There's always somebody whose main focus that day is on that project.
Wow. We are on site today at 215 28th Avenue South. Now, this is a multifamily property. There are 4 units. I'm going to take you on the outside of the units first, then we're going to go on a tour of the inside of one of the units. Before I do, I want you to notice something really quick. See that right there? That's the ocean. That's how close you are to the ocean at this property. Now, there's a unit downstairs and a unit upstairs, obviously. I want to really quick show you there's also a vacant lot. The powerful thing about this property is it allows for both short-term and long-term rentals. This is the other 2 units. Of course, the vacant lot is what I'm walking through right now. Just want you to get a good visual. All right, now I want to draw your attention to the top right corner of your screen on the split screen on the other side of the screen. Your purchase price was $1,652,211. Your acquisition cost were $33,044. That's a 2% broker fee for handling this transaction. Then you've got your loan cost of $24,783. Again, that is going to be 2% of the loan amount for this property, which is not the same as the purchase price because you are going to have to pay that 25% down. Now, if you take your purchase price, you add in your acquisition cost, you add in your loan cost, you take out the mortgage on the property, you're left with your initial investment into the property of $470,880. Now, I'm going to draw your attention to the taxable income section of the spreadsheet on your screen. Your potential rental income for this property, if it had 100% occupancy, was $310,667. That's for year one. Now, vacancy and credit losses, we took into account the 40% vacancy rate. So we took that out. That vacancy was $124,267. If you subtract that out from the $310,667, you're left with $186,400, which, if you recall, was the original number that we came up with all 4 units being rented 60% of the time. Now, moving right along, your gross operating income was $186,400. Your operating expenses, we have you at $42,872. If you subtract that from the $186,400, it is going to bring you to a net operating income of $143,528. Now, your interest for year one, the total amount of interest you're going to pay on this loan, financing 75% of it, was $86,141. Moving right along, your cost recovery, it came out to $37,000. That's the amount of depreciation that you can depreciate this unit in year one. Now, the depreciation was calculated by checking into the county assessor's records on the property, calculating the percentage of the improvements to the total value of the property according to the assessor. And the reason why we use the assessor's information is because it's defendable. You know, we're pointing to another source. We're saying, hey, the assessor gave us this, rather than saying we just figured this number out ourselves. So it's a whole lot more defendable if it comes into a question ever. Now, moving right along, we obviously, took into account straight line depreciation for this property and mid-month convention, taking into account that, you cannot, consider the first part of the month that you, in the first year that you purchased the property, and you can't consider the last part of the month in the year that you sell the property. So we took into account that mid-month convention. So that left us at $37,000 in cost recovery that could be taken in year one. Now, moving right along, you're going to also take out your amortization of loan cost. Essentially, we took that $24,783 in loan fees, and we amortize that over 5 years. Now, that's going to give us a real estate taxable income of $15,431. Essentially, we're going to take your net operating income, we're going to take out your interest, which is $86,141. We're going to take out your cost of recovery for the year, $37,000. We're going to take out your amortization of your loan cost, $4,957. And that's going to leave us with the taxable income that we have on this property in year one, which was at $15,431. Now, our tax liability ended up being a total of $5,709. That's 37% tax rate on the $15,431. Moving right along, let's take a look at your cash flow. Now, your net operating income again was $143,528. Your annual debt service was $105.97. That's your annual payment times 12 for the loan at 75% of the purchase price. Now, if you take your $143,528, your net operating income, and subtract out your annual debt service, you are left with a cash flow before taxes of as much as $38,431. If you take into account your tax liability at 37%, that's $5,709. Subtract that $38,431, and it is going to leave you with a cash flow after taxes of $32,721 in your first year. Now, for years 2 through 6, essentially we escalated the potential rental income by a 2% increase each year. Now, can we guarantee that? No. Can we ever guarantee future profits? No. In our mind, based on inflation, we're going to be increasing our rents. So there's a 2% escalation. My tie is running away from me. All right, so moving right along to vacancy and credit losses. Again, those increased again based on that same 2% scale. And your gross operating income came up again to $190,000, $128,000 in the second year, and of course increased again based on that 2% increase in your potential rental income. Now, some other things I want you to notice is your cost recovery in years 2, 3, and 4 were a little bit lower than in years 1 and 5. This is because in the year that you purchase the property, you have to honor the mid-month convention for the cost or recovery calculation. In the year that you sell the property, this presupposes that you're going to sell the property in year 5. Again, you have to honor that mid-month convention. So those years, you're not going to be able to claim quite as much depreciation on the property. However, in years 2, 3, and 4, you are going to be able to claim the full amount of depreciation because you don't have to account for mid-month convention. Now, I want to draw your attention again to the cash flow section of the spreadsheet. Your cash flow after taxes is going to steadily increase every single year through year 5, and it would potentially increase through year 6, again, keeping with that 2% escalation in potential rental income. I get calls and emails pretty much every day, all the time, from investors just like you looking to invest in commercial real estate deals, in short-term vacation rental properties, no matter what it is. If it is real estate, whether it's industrial, office, retail, medical office, I don't care what it is. If you want to invest in it, then you need a savvy investment broker to run financial analysis, market analysis, and feasibility studies on your investment to make sure that you are making a worthwhile investment. No matter what market you're in, pick up the phone and give me a call. It's 843-360-1737. All right, so moving right along, how do you evaluate a new market for potential real estate development?
Well, a new market or a new product, I mean, it's obviously you're keeping up with trends, you're keeping up with the trends in the industry, and what I'm usually looking for is what somebody's not doing. Or there are two things to look for. Either something's not doing, like everybody's doing high price and there needs to be a low price, or everybody's doing, high rise, there needs to be a low rise. Whatever, anything that's missing from the market. Secondly, I like to look for things that people have been successful at there that are new. That is, they may have been the first to do a new, mid-rise project, for example, and I want to be a close second. If I see somebody's success and it's not flooded yet, you got to get in there fast, because the problem is if you don't get in there fast, next thing you turn around and there'll be 6 more people doing the same project. Now that's market's overbuilt.
Saturated.
So you either want to, again, look for the gap yourself or look for the gap that somebody else has filled and be a close second.
Okay. Yeah. So tell me a little bit about the biggest challenges that you face as a developer. Like, how do you overcome them? What are they, and how do you win?
The biggest
Is it finding investors? Is
the
it
biggest problem is being
labor?
the biggest problem is being undercapitalized. Okay, if you don't have enough cash equity in the project, it's not just sweat equity. It's not just financing. If you're 100% financing, that's asking for trouble.
Okay.
So
Why is that?
because debt is a burden. It not only obviously costs money, but it costs you thinking. It costs your mind is taking space in your mind because you're worried about making payments instead of worried about moving the project down the line.
Wow.
And you're taking time, energy, and mind power away from the success of the project. So got to really think about, the what ifs. What if this project goes twice as slow? What if the market stalls and we got to live out a couple of years? What if it costs, an extra 20% to build this certain product? You have to make sure that you've got good partners, that you're fully capitalized for all the what ifs, and then you can put your mind on working out issues. But if you start out undercapitalized, you're going to be in trouble.
All right. So how do you overcome that?
How do you overcome it is, one, don't get in that position. Make sure you're capitalized to start with. The secondly is if you either need to sell out quickly, okay, let's correct this problem. Let's go ahead and take the hit and get sold out. Sometimes we've done that, and you lose a couple hundred over here and you hope to make a couple hundred over here. So you just get out. Okay, if it's not working, do whatever it takes to get out. You think you're going to have to sell it $100,000 short, and you got to sell it $200,000 short. That's okay. You're out, and you got your mind free to go do the successful one. Other thing is, okay, how do you solve it? You may have to bring in a partner. All of a sudden, you bring in. It's just like people go into bankruptcy and they get a bankruptcy lender who's lending on top of money that's already owed, but they take priority position. So you may have to find somebody who will take a priority position of 50% or even more ownership of the project, but the project's not going to succeed without them.
Yeah.
So, hey, look, I'd rather make 10% of 100,000 than make 100% of nothing.
Exactly.
So again, having the capital is the key.
Yep, absolutely. We're going to change gears and look at the alternative cash sales worksheet. Now, guys, this worksheet is going to tell us several different things. It's going to tell us the calculation for the adjusted basis. It's going to tell us the calculation for the capital gain on sale. It's also going to help us understand how much the property appreciated, which is that capital gain, and the sales proceeds after tax. Now, let's tackle the first part of this, the calculation of adjusted basis. The basis at acquisition, that $1,685,255, that is going to be your initial purchase price plus the acquisition cost. Now, we do have the cost recovery taken over the life of the investment was $189,813. If you subtract that from the basis at acquisition, it is going to leave you with an adjusted basis at sale of $1,495,442. That is our adjusted basis at sale. Now, we're going to move right along to the calculation of capital gain on sale. The sale price, again, was that $1,685,255. The cost of the sale was $33,705. That's 2% for broker fees. The adjusted basis at sale, again, we just calculated that, was the $1,495,442. Now, if we take the 1.6, which is the sale price, we take out, the sale price. we take out the cost of sale, we take out the adjusted basis, we are going to be left with the gain or the loss on the property. So that gain was $156,108. Additionally, we're going to step up and plug in that total cost recovery taken throughout the life of the investment. That was $189,813. Now, the difference there is the capital gain from appreciation. You can see that that number is negative. In other words, we were able to depreciate this property more than it appreciated. Now, we're going to move right along to, I don't want to skip real quick, your unamortized loan cost. We've got that over the life of the loan, that $24,783. And then our ordinary taxable income after that 5-year period was a negative $58,488. In other words, we didn't have taxable income for this property. Now, at the bottom there, we have the calculation of sales proceeds after tax. So we have our sales price of $1,821,460. That's $1,821,460. Now, the way that we arrived at that price, I kept this simple and easy. I kept the cap rate at 8.7%. Currently, it has an 8.7% cap rate based on my calculations. So I'm saying if things stay the same from year one and you own it for 5 years and sell it in year 5, if things stay the same, but the net operating income continues to increase on that 2% scale, then this property will be worth, in my opinion, $1,821,460 in year 6 when you sell the property. Now, so we also have the cost of sale in year 6 when you sell it of $36,429. That's 2% of that $1,821,460 sales price. Now, we also have to take out the mortgage balance. Obviously, if you're selling the property, you're going to have to pay off that loan. Now, that balance is $1,129,644. So if we start with the $1,821,460 sale price in year 6, we factor in the cost of paying brokerage fees of $36,429. We also pay off that mortgage. We are left with a sales proceeds before tax of $655,387. We have our tax savings. I used a 37% tax bracket. So of line 16, we had ordinary taxable income of $54,488. Well, 37% of that is going to put us at $21,641 for our ordinary income. Then we also have to pay what's called recapture, straight line recapture tax. Now, the government is going to want 25% recapture tax on the cost recovery that was taken throughout the life of the investment. So essentially, you'll see here that line 11 was $189,813 in cost recovery taken over that 5-year period. Well, they're going to want to get 25% of that back when you sell this property. That's going to bring us to a total of $37,963. Next, there's the tax on capital gains recapture. Now, that is going to be 20% of line 13. Line 13 was $33,705. It was a negative number, and 20% of that left us at $8,426. Now, if we take our sales proceeds after tax, we take out our ordinary taxable income, we've got to pay the government that 37% tax rate on our income from the property while we owned it. We've got to also take into account the straight line recapture that we've got to pay the government, the IRS, for depreciating that property. We've also got to make sure that we pay them 25% of our capital gains. They want that recapture as well. If we take that out of the sales proceeds before tax, we are left with a sales proceeds after tax of $647,491. You can see that this very well could be an extremely profitable investment, and it's standing right behind me, only a short distance to the beach.
So, what upcoming
real estate trends do you think investors should be paying attention to?
Well, that's a good question.
Everybody wants to know.
I'm probably not the best to answer that because I'm more on the end of my career rather than the start. So I'm not looking to start a ton of new things. But what you're looking for at any time, and again, it's like I said, what's being missed by the market. What trends are out there. That's something that you're looking. If you're looking for something I'm going to do for the next 10, 20 years, I'm trying to wind down over the next 5 years. So it's not high on my priority list, but what I'd be looking for, it's just like, we go back and forth between single family and multifamily. Sometimes multifamily, what's getting overbuilt? A lot of multifamily got overbuilt in certain markets, including here, because it was all high-end multifamily. And you can't do 100, high-end multifamily projects.
You got a gap in the market for
middle
to low end.
And no middle and no low end.
Yeah.
So you're always looking for those gaps, always.
Okay. And now, I mean, I know that you're no stranger to market downturns and recessions. What are your development strategies when you see that on the horizon or when we're in one? What do you do?
Well, you and I have talked about that before. The first thing I want to do in any project, in any development, is make sure I have the partners that I want in the project. Because if you run into trouble, a bad partner is going to be gone and not much help, and might even be making the problem worse. Making sure you have a partner who's going to stick with you, who's going to do their share of work and also supply their share of the money, and that they're totally honest and they got a track record for hanging in there and whatever. Just because you're buddies with somebody, you don't really know how some people are when they get under pressure.
Yeah. So speaking of that, we were talking at the office just the other day, which is what spurred this video. Kind of walk me through that incident that you had where you chose a partner that you shouldn't have chose, and kind of walk us through that lesson learned.
Well, if I always look back. It's easy to look back and say, well, I should have spent more time. But I had a partner that I thought was a good partner, had been successful, but he was that shiny bright thing. He was that next little shiny thing. Instead of me doing more research to look behind and see, well, he hadn't been a good partner in a couple of things before. He hadn't stuck with it. He tended to oversell or overstate something. And again, so the biggest thing is to vet somebody fully ahead of time. Take the time to go back 2 or 3 levels. Who has he partnered with before? What other projects have done? What do the partners say about him? Not just what does the market say or what does
his LinkedIn bio, his LinkedIn bio.
Yeah, things like that. You got to go a little bit deeper. And so, again, my lesson learned for that was to, always, great. Could be a great idea, but if you have a great idea and you have bad partners, even a great idea can stumble along the road, and bad partners can make the project fail as much as any other thing.
Yeah, so it's like that old adage in business: you can't grow your business faster than you can find the right people.
That's right.
It's the same kind of thing. So basically, you're saying just as much as the next big thing or the next great project is important, and knowing the right space, the right niche, the right product in the right market, all that stuff is important. You got to have that. But if you got the wrong people, it's going to mess you up.
That's right. The wrong people on your team or the wrong people as your partners. So you really have to, make sure you got a good team around you, and it starts with having the right partners.
Wonderful. All right, now let's talk just a little bit about private equity and financing, because I know as a developer, you've obviously done a lot of private equity. You have investors that you work with all the time. Do you mind going into how you structure financing for your large development deals?
Well, again, like I've shared here just earlier, you need capital. You don't need just loans. If everything's 100 and 110% financing, that can lead to trouble. The other thing is living out of your project. You know, you need to have, you need to not have it where 1 or 10 or 20 people are all getting their salaries from the new project. They need to be, you know, the partner you're looking to have partners who are putting money in, providing enough capital, and not drawing it out all the time, so you can survive the downturns. You know, you should have your income from something else, because a project takes a lot of money up front, and so that's the start of it. You know, is having enough capital. As far as financing, you know, you need to think about, again, what's the worst case scenario. It's great to have financing, because usually financing costs you less. Financing from a bank costs you less than giving up interest to a partner. You know, so if I could get enough with financing, that would be great. But what if the project stalls? And what's again that worst case scenario? How much am I going to need for a couple of years in order to get over that hump? Well, that's the kind of capital you need. You know,
and that's going to come from the right partners.
That's got to come from the right partners.
So basically you're saying you vet your partners in such a way, like, you know, you might even go so far, and I don't know this, but you might even go so far as to say, you know, hey, if worse comes to worse and we hit some kind of downturn in the market, you can get through for the next 2 years without this deal going through.
That's right. The other thing, I mean, anytime you put money in a project, you're looking, as far as the capital goes in, can you survive if you lost that money? Okay.
That's the kind of partners you involve.
Yeah, I don't want a partner who is, Randy, if this money goes away, whether it's $10,000 or $100,000 or $1 million, if this money goes away, I'm going to lose my home.
Yeah, you don't need that.
They don't need that stress. I don't need that stress. Nobody in the deal needs that stress. You know, you should only be investing money that you can afford to lose. That's number one.
Okay.
And, you know, and then as far as how much you borrow, I mean, again, it depends on if you're capitalized enough. You know, sometimes it's okay to borrow 50%. Sometimes it's okay to borrow 80%. You know, if you've got reserves and backup. But again, if you don't have reserves and backup, then you should be borrowing less money, not more money.
You might not need to be in that deal.
That's right.
Yeah. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because this is the fastest growing area out of the 150 most populated areas in the entire United States for the last 3 years in a row, according to U.S. News and World Report. This helps to insulate our market from many of the ups and downs that the rest of our nation's real estate market experiences. This can help you have a more stable rental property. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because they have a tremendous upside when compared to money market accounts and the stock market, due to the appreciation they earn and the potential of higher annual yields through their gross rental income when compared to these other investments. Money market accounts and the stock market don't have the upside of added appreciation. I believe you should invest in oceanfront condos in Myrtle Beach, South Carolina, because while our prices have risen and have held their value, we're also much cheaper than other places like Florida. Where else can you go and find an oceanfront condo for as little as $100,000? If you're getting into the real estate game or expanding your current portfolio, the bang for your buck is sitting right on the Myrtle Beach, South Carolina oceanfront. Now, regarding how I ran your mortgage numbers, you'll see on your screen there, I've got you at 12 payments per year. I have you amortized over 25 years. I have a loan amount of 25% of the purchase price. That's $1,239,158. Then I've got you at a 7% interest rate, which it could be less, it could be more, it depends on several factors. So I've got your periodic payment at $8,758.11. And then you can see if the loan played out, you know, for the full 25 years, what those payments would be for your interest, what the principal payment would be, what the balance each year is. Of course, I'm assuming that you're going to have a 5-year loan term on a property like this and then have to find additional funding or have the property paid off. Now, I am super excited to talk to you about this next screenshot, guys, because it's got your numbers on it, man. It's got your internal rate of return. It's got your net present value. It's going to show you what this investment is really worth to you. Now, let's say that your year zero cash flows are, again, that initial investment. You're gonna have to shell out that $470,880. Well, year one, you had those cash flows that we looked at $32,721 that you brought in. It wasn't negative, it was positive. Then year two, $34,616. Year three, $35,917. Then $37,216, and finally $37,916 in year five. Then in year 6, when you sell the property, or at the end of year 5, you sold it, and we looked at your numbers, you made $647,491. Well, if you have a discount rate of 12%, a hurdle rate, like 12% is what you're wanting to get out of this investment, then you can calculate what the net present value of this deal is to you. Now, when I ran those numbers, it shows us that if your hurdle rate is 12%, the property is presently, based on these cash flows over 5 years, it is overvalued by $24,066. In other words, you don't have to buy the property any cheaper in order to achieve that 12% hurdle rate. And in fact, you are to the clear, or you are in the surplus as much as $24,066. Now, your internal rate of return on this property was 13.27%. Come on. I get calls and emails pretty much every day, all the time, from investors just like you looking to invest in commercial real estate deals, in short-term vacation rental properties, no matter what it is. If it is real estate, whether it's industrial, office, retail, medical office, I don't care what it is. If you want to invest in it, then you need a savvy investment broker to run financial analysis, market analysis, and feasibility studies on your investment to make sure that you are making a worthwhile investment. No matter what market you're in, pick up the phone and give me a call. It's 843-360-1737.